All right. Just give me a second to get everything going. Morning, people. A little bit of a slow start. Hold on. Okay. Up. Good. Okay, so today we're going to be looking at two more companies that are already in the portfolio. Trying to sort of make up again for missed couple streams from last week. First company we're going to be looking at is ticker MO, Altria Group. Take a look at their investor relations page. Okay.
Good day, and welcome to the Altria Group 2021.
Lord have mercy.
First quarter earnings conference call. Today's call is scheduled to last about 1 hour, including remarks by Altria's management and a question and answer session. To ask a question during the session, you will need to press star 1 on your telephone. If you require any further assistance, press star 0. Representatives of the investment community and media on the call will be able to ask questions following the conclusion of the prepared remarks. I would now like to turn the call over to Mac Livingston, Vice President of Investor Relations for Altria Client Services. Please go ahead, sir.
Thanks, Stephanie. Good morning, and
love how the announcement chick has like her volume turned up to like 12 while the the actual manager has his at like 2. That's fantastic. That's not going to lead to a ridiculous sound discrepancy. I mean, I know a lot of my my live streams have had a lot of kind of awkward audio. I'm sort of in the process of trying to learn how to balance all that all together, but that's fantastic. So either way, whatever, maybe we'll just kind of ignore that for today. I'll just talk, I guess. So Altria is, for anybody who's not aware, the operator of the Marlboro cigarette brand in the United States, along with many other brands, but obviously that's the big one. They're the kind of the cousin company of PM, Philip Morris, which is kind of the more international distributor of Marlboro, while Altria retains the US distribution rights. But they're basically 2 different companies. Both are traded. They're in many ways paired at the hip because they're constantly working together and doing research together and stuff, because they used to be the same company, and they have essentially a lot of the same culture and a lot of the same, you know, background information stuff. So but kind of important to understand who at least PM is, because we will definitely discuss some of the things that company is doing. And when we discuss things that company is doing, we kind of just take it as almost given that Altria will likely do similar things, which in some ways is a dangerous attitude to have, but at the same time, it's something they have to do. Hold on just a second. All right. I deal with my fuzzy cat. Come here. Okay, so this is their little quarterly report, which is very interesting compared to lots of other companies. You know, a lot of them talk about whatever their biggest initiatives are, it comes in first, and usually have that like listed first. But it's very I don't know, outside the ordinary to have their cash return to shareholders be like the first thing that they talk about outside of like the headline information. But when they started getting into like different categories of information, which is what I'm to say, like this page onward, like this first page is kind of standard in a bit. It's like an initial statement plus like a little bit of like a headline piece with the revenues and the EPS. A little odd that they have a tax rate in here, I guess. I don't know, but in some ways it sort of makes sense with this company, because this company is subject to some interesting tax dynamics. But then they just jump right into cash return to shareholders, which I guess that's in some ways sort of like the elephant in the room. But this is definitely a huge dividend stock. Elephant's maybe an odd term for it, but their current dividend is like, what is it, over 7%. So it's a pretty hefty dividend. Don't get too focus on all the numbers in the valuation thing. We'll definitely be going over it, but huge dividend. As it says right here, long-term objective is to keep payout ratio at approximately 80% of adjusted diluted EPS. They're paying out most of their earnings in dividends, which that actually has to do partially with the, like I said, the reporting of the tax rate as sort of a primary effect, because of Altria's mature status and in a lot of ways kind of negative sentiment that exists around this industry in the market. They're often the subject of lots of lawsuits, you know, and politicians campaigns and all sorts of things. So the But yeah, so Altria essentially feels obligated to constantly be paying out a massive amount of dividends. Otherwise, they end up with a large amount of cash. And if they have a huge cash on their balance sheet, while that could allow protection for a lot of companies, that actually puts them in a dangerous position because it makes them a target of political action, as well as there would also be some takeover action that could be a threat too. But so they're always constantly pumping out dividends, but obviously you can only increase dividends so fast at a sustainable rate without being too risky. So they're also all pumping out lots of share buybacks. It says here they have a 2 billion share buyback repurchase program with 1.7 billion left in it. It says further down in here, or actually it is right up here. They did $325 million in this quarter, which gave them about 7 million shares at a price of 47, which it's a little bit lower now, so you could actually get a little bit more shares than that at the current price. But just kind of rough math, 3 times that to get to a billion, which would be 21 million shares, and then you could essentially add maybe 2 more of them to sort of make up for the 0.7, so that would come up to be roughly 37 million shares theoretically that could be purchased, which isn't exactly a huge cut on the share count, but it is still about 2%. So theoretically they will be cutting their share count by about 2%, and it's supposed to complete by June 30th 2020, which is only a little bit over a year from now, like 14 months or so approximately. So that's pretty good. And now in the next section, which is even more curious than the fact that they would start with the cash return to shareholders, they then start after that, as far as like the segments, they start with the non-combustible products business platform, which is the faster growing part of their business. It's the part that's the new age product, and allowing them to essentially expand their portfolio and hopefully diversify away from the decline of cigarettes in a general sense, while still maintaining the overall tobacco industry. But it's still a minor part of their business. So the fact that they listed first is very interesting, which will there's psychological reasons partially why they're doing it. They want to talk about the most impressive things. Obviously, this paper is meant to be presented, and they're sort of hoping that you work through the first couple of pages and maybe never get to the rest of the report. But it is interesting. But that sort of gets straight to the point of what I was saying before, because look at how quickly they mentioned PM USA. They're talking about the IQOS product, which is essentially the heated vapor tobacco that they've actually been introducing across Europe for the last couple of years, and it's actually been very, very successful. And they just now, and basically this last quarter, really starting to bring it into the US. Well, it began actually in the fourth quarter, but this first quarter is sort of like the first real quarter where they actually had a very solid amount of sales, because it sort of began like partway through last year. Yeah, as it says right here, they've expanded into stores statewide in Georgia, Virginia, North Carolina, South Carolina. Obviously, those are states all in the South. Definitely have slightly different dynamics than other states. Probably not going to get to places like California or New York necessarily so fast, because of politicians that are a little bit less friendly towards this industry. And like in California specifically, that's very much in vogue to sort of be going after tobacco companies. That's like an easy target for local politicians. But then there's also the oral tobacco, which they have this product on that they're starting to distribute as well. On exclamation mark. Which they had as recent as last quarter. They had 80% of the company, but they actually also closed out buying the rest of the 20% from the other company that had the on business internationally, which apparently only costed them $250 million. So now they own 100% of the on business, which is good, I suppose. get some full control. I mean, they already had control because they had 80%, but now they have, you know, the full stake, so now they don't have to pass off any of the earnings to anybody else. So that's good. Second. There we go. And then other major investments that they've kind of been making over the years as they've attempted to essentially use their giant piles of cash outside of the cash that they pay out to shareholders. Like I said, they're constantly always trying to get rid of cash. That's basically the trend with this company, is that they have tons of cash, they just have to get rid of it. But they bought into Juul, the vaping product that's extremely popular with younger generation, and there was a whole lot of bad press a little over a year ago, in like late 2019 moving into early 2020. There was a lot of bad press, what with bad shipments coming over from, I believe, China, with impurities or something in the cartridges that was causing some medical concerns. I believe a few people died, and several other people were given major medical issues, and there was a whole lot of hullabaloo. It didn't actually even happen in any Juul products directly. It just happened in vapored products and flavored vapor products, and it was there was just a big whole talk about it. And this was also on the back of there also already being lawsuits, these ones much more directly at Juul, about their advertising campaign, because it was being said that Juul was advertising directly to teenagers and children, which, yeah, you know, abominable and whatever ways you want to say, of course. So this has obviously been kind of a negativity, a little bit of a weighting down on their valuation, a lot, because all the bad press has kind of come out around this, and just around vapor products as well. And that was, like I said, that whole bad health thing was happening at the end of 2019 moving into 2020. And then what happened in 2020? Oh, well, you know, we had this global pandemic that happened to be focused around a kind of lung-based illness. Not entirely lung-based, but, you know, coughing, breathing, all that jazz. So the idea of smokable products almost got more into question. You can definitely essentially brought that even further down. But there's also sort of another way to look at the Juul investment, because as a result of all this bad press, Juul has had its valuation slashed multiple times, which Juul is not a publicly traded company, it's a privately traded company, and most of Juul is owned by Altria at this point, which they've been slowly buying up larger and larger chunks of it. And as I said, they've been slashing their own balance sheet book value of the acquisition. As it says down here, the fair value as of March 31st is 1.5 billion. I can't actually remember what it was when they first purchased it, but I think it was more like 5 or 6 billion or something when they purchased it. So you can see it's like they have absolutely slashed the valuation of it. Now I've sort of heard an interesting perspective on this. Shout out to the YouTube channel PPC Ian. Ian, I've been watching his videos for a long time. He's definitely a very dividend focused investor, but he's very knowledgeable, especially on this space. He has a lot of experience with it. But he kind of brought a lot of interesting points on that to my attention in some of his videos from way back then, which was just the idea of the fact that they have such control over the fair value and what that essentially means possibly for the future because of other things. And it's like if they believed that the value of Juul was really decreasing, they wouldn't be putting it so high up in their report, for example. You know, it's like I said, it's like they're trying to focus on it in some ways, but at the same time they're slashing the valuation. But other things they're doing is they're also putting a lot of their own people inside through a lot of these lawsuits and concerns. Part of the agreements that have resulted from them has been the takeover essentially of the board in a large way by Altria members. They've essentially gotten to like pick all the people they want to be there. So in large ways, Juul is becoming like a 100% extension of Altria at this point. And the real question is well, if you've already have a large amount of control, it just comes down to ownership, right? And well, if you only own, I can't remember what portion of it they own. I think they own like 75%, but if you only own 51% of a company, you have control, and therefore you can make large effects on the valuation with that. But that actually affects what the amount of the remaining portion that you don't own is actually worth. So that basically makes it easier for them to acquire the remaining portion of the business, which is essentially what PPC had suggested, is that they were essentially prepping to really take Juul fully into full subsidiaryship, which we haven't seen that happen quite yet. But the point is, it definitely seems like that's the case. Sometimes you have to read between the lines with all the corporate governance stuff, and like when you get the reports come out about who quit which company and joined which board and how they shuffled people around. It's like a lot of times there's that you can see their plans kind of written on their sleeve when they make these moves. So that's just one interesting thing to think about. And then after Juul, it kind of goes down into here and it talks about, well, capital markets, which is an interesting direction to go after that. There is a decent amount of debt associated with Altria. It is a pretty mature company, and it's going through obviously a secular decline as cigarette volumes have been decreasing for decades, but they have still a large amount of debt that has to be managed. But one thing about their debt relative to a lot of companies is that they actually do have a pretty large maturity. Let me go take a look at what I have in spreadsheet. So yeah, okay. 33 years is their weighted average maturity as of the 10Q from the last quarter, which probably hasn't shifted much. In fact, they probably shifted it forward a little bit. It might be like 34 or 35 now, but we're not really going to adjust for that. That's fine enough. We're not super worried about that. But the point is most companies, I mean, if you watch any of my other valuations, you may have seen, it's like they don't usually have greatly more than 10. Like sometimes it's less, but between like 5 and 15 years is probably the more typical range for a weighted average maturity for a company's debt. So they do have a lot of debt, but they're not expected to pay it for a very long time, is essentially my point. And then they have a relatively good coupon rate. They say that their coupon rate dropped from 4.1 to 4 in this quarter, which, as I show right here in the 10Q, I have 4.15 here, which is roughly right. It doesn't make a huge difference if we're off slightly. And also, when I put things into that bottom spreadsheet there, I often use effective interest rates that they list, which could be throwing that off. And if you kind of go up to where their actual income statement is and you look at what they're actually paying, well, over the last 3 years, it's closer to 3.89. And I mean, you can sort of fiddle with it to get a different idea of over what length of time they've been paying what rate. 3-year average generally. In the next section, they start talking about ESG, which we're just totally going to skip because I don't really care about ESG. Sorry for anybody that does. I mean, I guess I care about the little governance bit here, but really they're just talking about the fact that one of their board members passed away. So rest in peace to him, I suppose. Anyway, impact from the COVID-19 pandemic, which this is has a little bit of some interesting. It's not really much. They don't really say much here, but either way, They kind of talk about the tobacco business in general. They claim that Altria's tobacco business was not affected at all by COVID-19, which, considering, like I said, it's a respiratory disease, it's a little bit interesting to see how that happens, but we'll see some data later that somewhat backs that up. We can take a look at that. It changed a lot of people's buying habits surrounding tobacco, but it didn't necessarily affect the overall business. And I mean, in some ways that's a bold claim, because they're still down on their revenues from Q1 2020, which is basically the last pre-COVID quarter. Their revenues are down 5%, which is a little bit large for them. And if you take out the excise taxes, 3.3. But I'm not really sure what the point of looking at revenues net of excise taxes. I mean, I guess that's because they want you to focus on the voluminous decline, but I think that the excise taxes are inherent. So it's like, it's not like you're going to be able to ever capture on volumes without the excise taxes, right? So it doesn't really make a difference. So whatever, 5.1. Yeah, as it says here, the majority of retail stores in which tobacco products are sold, including convenience stores, have been deemed to be essential businesses by authorities and remain open, which is, definitely the case. It's like every place that tobacco is sold is pretty much the list of places that were completely unaffected by the pandemic. So that doesn't really affect much. But they also have a wine business, the Chateau Michel, which that apparently was heavily affected, which is definitely not great to see. It says that they have a direct consumer part of their business, but I wish that they had more than just, this one line here. It's like, actually, I wish they had a little bit of a larger section on the wine in here, but we can kind of dive a little bit deeper on that later, because I do actually really like the fact that they have this wine operation. Overall, I mean, they're pretty well expanded to alcohol in general, because they also have their ABI investment, AB and Bev, and other investments. So they're invested in wine, they're invested in beer, they're invested in vaping products, and as it also says here, they're invested in Kronos. So they're also invested in cannabis. They do talk about this. They're kind of waiting on hopeful. ABI did not provide earnings guidance for 2021, so that kind of gives uncertainty to the overall valuation for their investment in that. And as it says here, stock prices in the first half of 2020, there was a pretty large decline for them, but hopefully that'll recover. We already talked about Juul. And with Kronos, in many ways, it's sort of just a waiting game, because it's in many ways just a wait until maybe federal legalization comes. That might come in the next couple of years, hopefully. But it sort of feels like they've been saying it might come in the next couple of years for a long time now. So, maybe that's a bit hopeful, but we'll see what happens there. As it says, it was infected by COVID-19 due in part to actions limiting access to the retail stores in the United States and Canada. In general, I know in my state, they did deem cannabis shops to be an essential business, but only for the medical patient side, and which I'm not really sure what the distribution of medical patients versus recreational is in my state, and whether or not that's even typical compared to most states. And I have no idea how that would compare to Canada exactly, but I'm sure that's part of it here. I don't know. I'm not really sure if Kronos has much in the way of recreational business, or if they're like all medical. But either way, so now we're sort of at the bottom of this little opening bit here. They get to their guidance, which they're still guiding at a growth rate of 3.6% in their adjusted diluted EPS, which we'll get into see what some of their adjustments are, but it's pretty typical sets of adjustments. It's not really the type of adjustments that I agree with. So, but Either way, that 3 to 6% range is probably still about similar, even off of gap. It's usually not that different. Which this is basically the same growth rate that they've guided in general for like the last couple years. This definitely is a company that I've been in for some time, and then here they are also guiding their tax rate. All right, so hopefully we can get into some of the more specific financial charts and performance. Here it shows those adjustments, as I was just saying. Reported diluted EPS would be 77 cents versus 83 cents, so that's actually a decline of 7.2, and the adjusted is actually a decline of 1.8. Okay, so actually I was a little bit wrong on that one. They do manage to find lots of adjustments to fix this year compared to last year. Either way in this, but either way, like I said, they're still guiding that the adjusted is going to be up from the first year, which is interesting because it's still declining in the first quarter. So it suggests that either way it should be significantly larger in the second or the third and the fourth. You have the fair value changes definitely makes up a big part of it, and the loss on early extinguishment of debt, which I can agree with the fair value change, because fair value accounting is definitely a huge mess. Companies should not be in the business of valuing companies unless they're making acquisitions, at which point they should probably be hiring third parties to do the valuation process in the first place. So this new wave thing of having companies do all of the fair value adjustments for their book value investments is a total mess. Warren Buffett has talked about this many times, along with Charlie Munger. It's a huge mess. So I would actually forgive them of this 10 cents. But this 27 cents, which is actually the lion's share, obviously, is on loss of early extinguishment of debt. But I don't really see that as some sort of like, oh, non-real charge. Loss on early extinguishment of debt is a real charge, and it's an important charge because you're extinguishing debt, which is something that has to be done if you're going to roll over into a larger maturity or a lower interest rate, which is what we had talked about. They were so proud of having killed 10 basis points of interest rate. So if you're proud of killing the 10 basis points of interest rate, well, then you have to be proud of the 27 cent reported diluted EPS loss that gives you. Or the special charges here, and then here they're talking about the fair value adjustments, which again kind of suck. All right, so we can get into some of the segments. Smokable products. See, now when they actually get down to the into talking about their segments, there's less playing around. They get straight to the smokable products, which is the actual vast majority of the revenues. So the net revenue from quarter to quarter of 2020 to 2021 is down 6.4% on net revenues, and if you net out the excise taxes, is actually 4.6%. Interesting enough, showing that their overall adjusted OCI margins has actually come up from 55.3 to 57.5. Interesting that's happened. It's probably due to their overall pricing power in a general sense. I mean, like I said, that they hold the Marlboro brand, which is obviously the top brand and the higher price brand. I would be curious also to actually see whether or not any of the lower brands in the cigarette space, how many of them went out of business last year. It's very possible that some of their smaller competitors kind of got wiped from the table, as well as lots of boutique smoke shops were probably not open, which might have been the locations where some somewhat less common smokable products were being sold. So that also took away some of those sales, and those people were forced to go to the convenience stores where they maybe didn't normally go to as often to get their cigarettes. So that would lead to those higher margins, as well as because they weren't able to go to certain smoke shops, they may not have been able to buy in quite the same level of bulk that they otherwise would. So they may have been forced to purchase in smaller increments the same quantities that they otherwise would. Not to mention the dynamics of the pandemic and the shutdown led to a large amount of people buying up large volumes at disproportionately odd times, which we'll get into when we get to that data. They have a pretty nice little chart to kind of look at that for. As it says here, the overall reported domestic cigarette shipment volume is decreased 12%, but according to them, that's primarily driven by trade inventory movement. So supposedly we shouldn't really pay attention to that. They do have another graph that kind of show off to that. Over here, okay, so we actually get into the shipment volume in sticks in millions based off of their groupings of different brands, which they specifically spell out Marlboro by itself, but you can see just how much of their shipment is Marlboro, which the shipment, and again, this is just in cigarettes, not in dollars. So this is in total volumes. They're down 11.1% from the year-over-year quarter versus other premium brands, which I guess would be other major well-known brands, but not Marlboro. They're actually down 13.7% versus their more discount brands, which include some of the cheaper and less quality tobacco, down 20.9%. And so you can see that how that overall distribution, the total volume is down 12%, but Marlboro is actually only down 11.1%. And that's exactly what I mean about how we ended up with these increased margins in a general sense, is because they're essentially pushing their customers out of these products into these products, even though this is a bit of a decline. It's like all three of these declined, but some of these guys essentially just went to here instead. And if it wasn't for that fact, this line would probably be a little bit more in line with it. But then they also have cigars, which the more popular category being black and mild versus other, the discrepancy between two is even larger. Which for cigars, the shipments are actually up, which is a little curious to see. I'm not 100% sure exactly how to explain that, and they don't really give any specific information to try to talk about that. I guess maybe you could argue that maybe there was just a way less purchase of the cigars during the first quarter of last year for prepping for the pandemic, but really I would have expected that more to show up in the second quarter. But I suppose maybe we'll take a look at that whenever the second quarter numbers come out, and we kind of look at this same box in the next quarter. But you wouldn't have expected to see quite the same level, because what I could see essentially is that during the pandemic I could see people essentially full stop not buying cigars and instead just shifting over to cigarettes, because it becomes less about taste and preference, and becomes more about just trying to get the fix as minimal as one can be. And then they also show the market share here, retail share, which again for Marlboro has actually increased over the last year, while apparently the other premiums stayed flat and the discount has gone down. So they lost ground in the discount and they shifted it to the Marlboro, which is definitely not a loss as far as Altria is concerned. That's exactly what they want, and like I said, that leads to the margin increase, which it's worth noting that very well might reverse itself. So now switching into the oral tobacco products, we're probably going to spend less time on these other sections because, well, frankly, I just don't know as much about oral tobacco products. So I mean, it really just comes down to surface level understanding a bit more on them. But as you can see, the net revenues for the oral products actually did increase, and also increased net of excise taxes, though the OCI did decrease, and the OCI margins also got compressed a little bit. But that's okay. versus the cigarettes. See, on cigarettes, it's more about managing the brand and trying to really eke out the profits. But this is also their growing space. So because this is the growing product, it's not so much about actually keeping the really high margins. Not to mention, again, look at those really high margins versus these margins. And these are already really high margins because this is, like I said, the vast majority of this comes from Marlboro, which is a high brand name category. It's their premium brand. It's the top of the market. It's the Coca-Cola of cigarettes, you know. So it has the highest brand power, the highest margins. Margins are the signifier of brand. So frankly, the fact that the oral product has such huge margins as this is really not sustainable long run. This is definitely how you know that this is a premium product that is growing. And it's like by the end of their growing process, I'd be shocked if they had higher margins than the other business. But the point is, this definitely gives them this is what you could consider essentially like their runway for their growth in a large way, because it's like, it's the better they can manage this, the better their growth goes. And the fact that they only lost 0.9 percentage on the OCI margin while still gaining 4.4% on revenue net of excise is, you know, pretty sweet. But obviously you can see that the net revenue is only you know, a fraction over $500 million versus the rather the rather huge percentage of the business that comes from cigarettes, a little over $5 billion. Here's the shipment volumes on those groups. The Copenhagen oral product, which is definitely the more popular one, down 1.7%. This is again shipment volumes in cans and packs. Skull down 6%, which is also interesting. And then, as you can see here, the Red Seal and On products, which is really the more growing categories. These are a little bit more traditional oral products versus these newer oral products. And the newer oral products grew rather strongly, 31.4% in volumes from year over year. That's fantastic. But these categories were decreasing. And overall, on balance, they managed to eke out a slight gain of a little over 0.5% in the overall volumes for that, which is great. But it does obviously beg the question of just how much of this growth comes essentially at the expense of these other two categories. It's like, really, this is a large amount of shifting into here. Obviously, like I said, it still on balance came out positive, but it definitely throws some cold water on this large number here. So let's not overly overestimate essentially the value of this growth. Really pretty minimal growth on the total oral tobacco products, and then again, the total oral tobacco revenues are pretty small, relatively speaking. But again, it has high margins, which is part of the reason that the net revenue number can be up so strongly, even on the back of a pretty small shift in the shipment volumes. Essentially, if you have to be transforming your business from one product to another, which, I mean, I actually have many companies in my portfolio where this is the case, where essentially like one segment is sort of vampirizing another segment, and they're sort of trying to transform the business. A lot of investors definitely avoid stocks like that because there's a lot of uncertainty surrounding that. I guess you could say that that's like a type of uncertainty that I almost feel more confident dealing with. It's like, I feel like I'm good at making the judgments about whether or not one segment can take over another segment a little bit better. But the thing I sort of want to point out with that is that the fact that, like I said, there's this massive difference in the margins during this process, it actually totally is, that's exactly what you want to see. That's exactly how you can tell whether or not a product can possibly shift in its business. It's like, if you have to vampirize one segment for another, then what you want is that the segment that's doing the vampiric action to be a higher margin business with high growth, and then hopefully the business is being vampirized to have negative growth, because that's what makes it be vampirized. But hopefully that negative growth is at a much slower rate overall to the high growth of the new segment, and ideally it has lower margins than the new segment 2, which essentially means that you're really making an efficiency choice. You know, you're moving from a waste of capital and expenses into a savings of capital and expenses. So anyway, also into the wine segment, as I said before, it's a category that I find pretty valuable to the company overall for diversification, but it definitely was facing lots of difficulties through the pandemic, as we were saying before, because this business is definitely a little bit more of a little bit of a niche business. It's not exactly an essential business in quite the same way where all their cigarettes are sold in every corner. I mean, some of the wines that this company sells is still sold at a lot of those locations, but they also have their own premises, and as it said in the section way up above, there's also the direct consumer section of it. So this part of their business definitely had to adjust to the pandemic in a large way. Overall, the net volumes from quarter to quarter were up. It was really just in the yearly that there was a lot of problems. And again, that's partially because we're still looking at the first quarters. When we get to next quarter and we're seeing the second quarter year-over-year shift, I'm pretty sure that's going to be a lot more of a negative percentage. So really, it's like we're seeing what it was looking like before, which you can see that it was actually growing. Not a huge growth, but growth. Which, you know, alcohol is not exactly a high growth industry. In fact, in many ways, it too is in secular decline. But that, I think, is less of a solid secular trend versus cigarette volumes. Cigarette volumes has been a long-standing cultural shift that's been going on for a long way. It actually has a strong underlying basis, and kind of the shift away from alcohol. While there is in many ways a cultural shift away from alcohol, I think it's a lot more tepid, and I don't think it's quite as justified. It's hard to sort of, I don't know, moralizing, I guess, on the use of one intoxicant versus another. Alcohol and cigarettes are both drugs, you know, as far as I'm concerned. So, and I say that as somebody who will consume both, you know. I'm not, when I say moralizing, I'm not making any judgments on anybody, but here I'm just talking about normative statements. But the idea that cigarettes are bad for people and alcohol is bad for people, and if you take this into consideration versus, for example, like the growing secular trend towards cannabis, and like a lot of the arguments that people use for cannabis is that, oh, you know, cigarette smoking is bad, weed smoking is better for you. People try to act like it's good for you. It's not good for you, but you know, it might be better for you because it can be used for various medicinal reasons, and so people, because it has positive benefits, people are often willing to overlook the negative effects. And then well, a little bit more of a direct comparison that is less about trying to make it good, because when people compare cannabis to cigarettes, a lot of times they're trying to act like it's good, but what they will do when they compare cannabis to alcohol, it's less about trying to make it sound good and more just trying to say it's better. And that's much more of a solid argument than the cigarette one, because as far as I'm concerned, you're still burning a plant material and inhaling it, and I think it's pretty hard to argue that burning any material and inhaling it is good for you, regardless of the medicinal benefits of the active ingredient. And the thing about cannabis is obviously you can consume it in other ways, right? You can have edibles and other such things. And well, I think the official science is still a little bit out. I'd probably be willing to put a lot of money on the overall benefits of oral cannabis versus smoked cannabis. So therefore, oral cannabis would be a massive win over cigarettes, and it would also be a win over alcohol. But even so, if we're just talking smoked cannabis, I think the argument is still pretty solid to say that smoked cannabis is less dangerous than alcohol for a variety of reasons, even though it still has burned plant material inhaled into your lungs. But anyway, whatever. off of sort of that kind of cultural trend point, alcohol is, like I said, there's sort of like a little bit of a shift away from high alcohol usages. You know, people will definitely look askance at alcoholics more these days, but people don't look askance at having a drink, right? So, but they do look askance at having a cigarette. So you see, you can sort of see my point. It's like it's like if somebody smokes 2 packs a day, they're like a hardcore addict. Or they drink a bottle of wine a day, they're also a hardcore addict. Under those 2 circumstances, I think the person that drinks the bottle of wine a day is probably going to be judged harder than the person that smokes 2 packs of cigarettes a day. But which one is actually going to have the health effects hit them first? Well, I think it's probably pretty up in the air for that, right? But if you bring it down from like a high addictive level and try to bring it down to more of just like a social level and say, okay, well, what about somebody who has like 1 cigarette a day versus somebody who has 1 small glass a day, or 2 cigarettes a day versus 1 glass a day, or something like that, something a little bit more in the reasonable range. But I think it does get a little bit harder to tell the difference between the average social reaction. Obviously, this is very different depending on where you go, but it's like different states will have different attitudes about this, different peoples, different countries even. I mean, we're primarily talking about the US because this business is basically just in the US. Like I said, PM handles a lot of the national business, but this is sort of true everywhere. It's just there's slightly different trends in different locations. But I do think that at this point, people will accept the person with the 1 glass of wine more than the person that smokes the 1 cigarette. The person who smokes the 1 cigarette still has to go to the smoking area, right? Just because it's 1 cigarette doesn't mean that everyone's gonna forgive them for breathing the smoke in their face. Nobody cares if you drink the glass of wine in front of them. The only thing they're gonna care about is if you hop in a car, right? Or if you're breastfeeding or something, you know, pregnant, something like that. You know, it's like those are the only circumstances that somebody's going to judge you for having 1 glass of wine, is if you're specifically putting somebody else in danger, which kind of is the point of the smoking the cigarette in them. But the point is, it's much easier to quote unquote put somebody in danger with the 1 cigarette than it is with the alcohol, even though you could argue that the danger is much higher with the alcohol. For example, if the person gets behind the wheel of a vehicle, or gets behind the steering wheel of a vehicle. So yeah, but anyway, enough about secular trends of wine, cigarettes, and cannabis. Getting back into the actual wine discussion, I was going to say, all that was really just me sort of trying to argue about why it is that their growth rate is pretty strong relative to cigarettes, even in, like I said, the first quarter. Though once we get to the second and third quarter, I'm sure it'll be declines, and it'll probably be much sharper declines as well because of the fact that they didn't have the availability of business. But either way, what they do have is a pretty strong increase in the margins. I'm not 100% sure exactly what's driving all the major differences there, but it probably has to do with just cutting costs in general sense, and overall, being the Chateau Michel, it does in general have a decent branding power, so it has pretty good margin spacing to begin with. But this also could be in preparation for the shutdowns. We'll have to see what it looks like in the second quarter to make a stronger judgment there. But either way, it is curious to see the growth in the margin overall, even though, like I said, this is a pretty low margin relative to the other margins we were talking about. All right, this is all just the forward-looking statement stuff, and then it gets into their actual financials. Yeah, so between the overall first quarters, like I said, overall net revenues are down about 5%, with the gross profit margin being about 13.9%, and then their operating margin coming to 15.3% after all the market administration research costs, which still increase regardless of the decline in revenue. So their operating income did actually go up, which is good to see, partially because of the shift in excise taxes as well as the lowering of cost of sales. They were probably able to slow down a large amount of the volume movements and shippings, which is sort of talks about someone in here, as well as, let's see what it has. Cost of sales include charges for resolution expenses related to state settlement agreements and FDA user fees. Supplemental information concerning those items, excise taxes on products sold, income losses from equity investments is shown in the schedule. So it shifts in the equity investments as well as excise taxes. Yeah. So even though they had the revenues come down, they were able to manage that into the profit, which is good. But overall, their net earnings still comes down because of a variety of other factors, as you can see here. They increased their interest payments. They had to do that early extinguishment of the debt that we were talking about, as well as the shifts from the equity investments, and also the gain loss on the financial instruments related to Kronos, fair value, and all that stuff. So overall, their net earnings were down about 8%, which I would say is relatively for pretty good reasons. I would say this is a pretty good, a well-managed decline overall for that first quarter. I'm not saying that I'll necessarily agree with that in the next quarter or the quarter after that when we look at those comparative bases, but overall it did a good job. And they did bring down the weighted average diluted share count slightly. They're going to be relatively flat probably for the next couple of quarters, but either way, there's that. And here they show the net revenues of the different segments side by side. So you can see the smokable product is down 6.4%, 4.2% up on the oral, up 2.7% on wine, up 67% on the other new categories, which overall makes for 5.1% decline, because this just makes up a massive lion's share compared to the other groupings. And then same thing for the operating income. Operating income for the smokable products actually went up because they managed the margins so well. And then the oral products that actually came down regardless of the revenue growth, but because of that's in growing categories, that's actually sort of acceptable to take on the losses in order to get the growth. And then that would probably in many ways be the same here if it wasn't for the fact that they actually took on a decent loss in 2020 from the wine to begin with. So even just eking out the profit that they did in this quarter is just a massive improvement compared to the wine. And then while all others are still down, but yeah, that sort of goes in line with the fact that it's trying to grow as quickly as possible. So I do think that's all I wanted to look at primarily on this one. I guess we'll look at the balance sheet as well a little bit. Yeah, okay, so we'll look at the balance sheet on this and then we'll move on to their other presentation thing. Let's see, hold on just a second. Check OBS real quick. Okay, cool. So we're about an hour in. Gotta make sure I don't ramble too much about secular trends related to cigarettes and not get to the other company. Unlike Monday, I do actually have to work today. So even though I'm doing two companies again, I want to make sure that we balance timing of them well. And because we're talking about the business of this a lot more, but when we get to Shell, which is the other company that we're going to be doing today, it's a little bit more of talking about the actual dynamics evaluation for that one, because it's a commodity company. So the method by which you value them is a little bit more complex than a standard company, which I'll get into in a bit. Either way, so let's see, their assets came up, but so did their liabilities, roughly by about the same amount. Built up their cash pile, which again is kind of a dangerous thing for them to do. Their inventories are actually coming down, which is good. We really want to see their inventories come down as much as possible with the decline of the volumes. also bringing the netted value of their property, plant, and equipment down, which is not really of high consequence too much for this business. Their property, plant, and equipment is relatively cheap compared to other companies. Cheap per dollar, which is perhaps a complicated concept to get around. I'm not saying cheap in like the total value of it, but like cheap in what they get out of the small amount of dollars that they actually have to invest. It's like I said, they only have $1 to $2 billion, about $2 billion really, $2 billion netted property, plant, and equipment, which is probably because of that netted factor. It doesn't actually list the depreciation, it just includes it automatically. But the point is, they probably have tens of billions of dollars of property, plant, and equipment, but they don't really have to replace it much because it's relatively cheap. So they've managed to net probably a larger percentage of their property, plant, and equipment out relative to the actual purchase cost through depreciation compared to most other companies, because they're the type of company with the type of manufacturing base that just doesn't need to be replaced at nearly the same clip, because it's a much more relaxed type of manufacturing. I mean, it's just making cigarettes, you know? I mean, cigarettes are just paper and tobacco, right? A little bit of styrofoam. Yeah, huge amount of goodwill. That's the interesting thing about their balance sheet, is obviously they've made some pretty large acquisitions. So really, that's managing the goodwill and managing to impair portions of it that are not worthy is kind of actually an important part of the business to overall bring their returns on capital up. Although they already have really high returns on capital, so the truth is that they don't actually really need to impair the goodwill. Impairing the goodwill just kind of hurts their earnings in a large way. But like I said, sometimes you have to do that for strategic reasons, like I was talking about with the Jewel acquisition and how they're probably using that to position themselves for further purchases down the road. And then they also have investments in equity securities, which we were also talking about, the ABI and the Kronos and the Jewel investment. I do believe that all comes up into here, which takes on some effects because of fair value accounting, but it also increases depending on which one, the overall balance between these things. And it shows their total debt. And here at the bottom, the debt is actually increased from those quarters to quarter, but it also talks about their plans to extinguish their debt above their, it says, actually up at the top, I do think I skipped that part. Yeah, because I was talking about the change in their maturity and the basis points, but they're actually planning to retire approximately 1.5 billion in aggregate principal in May, in the second quarter, and they're not talking about rolling that over. So that is interesting to see that they're going to supposedly get rid of actual debt, not just roll it over. So we'll have to see if they actually uphold that or if they're just kind of talking it up, because it would be nice to see them drop a decent portion of their debt. And be about 5% of their debt gone, if they're being real about that. So that'd be cool. Yeah, either way, so we're done with that. That's the quarterly report, and this is a little bit more of their quarterly metrics. They kind of put things through that. I think there was maybe one or two things in here I wanted to talk about. Hold on. Talking about the long-term secular decline rate, as they've kind of been adjusting it, sort of like a perceived historical adjusted decline rate, and then they kind of make adjustments based off of effects from price elasticity as well as other macroeconomic factors to try to come up with that. I don't really fully understand how it is that they come up with this weird aggregated set of secular decline, but it's either way kind of curious, showing the change in the growth rates. It's definitely curious to see, because this was obviously sort of like pre-pandemic, and this shows like the spike in the pandemic. People were buying. You could also say this is because of the increase in the stimulus, because the stimulus was kind of coming out during this time frame, or early in this time frame. So people had a lot of extra money. They were throwing it out there, which could also have something to do. Oh no, actually, because this is oral tobacco, so I was going to say that could have to do with the higher margins, but their margins were actually crushed down. So that could be a little counter to what I was going to say. But interesting to see that this most recent quarter was back down to sort of the same growth rate. But And then yeah, showing overall 21 plus vapors and their overall past 30-day usage from across many different years, as well as including the most recent quarter, showing the overall distribution of people who also smoke cigarettes and people who do not smoke cigarettes. So you can see that people who vape and also smoke cigarettes were larger in the past. It started coming down. This looks like it was sort of a low point here. It looks like it was sort of climbing back up a little bit, and then it came down in 2020. That could have to do with, like I was saying before, the perceptions surrounding the negative effects of vaping that were being discussed at the beginning of 2020 and the end of 2019, as well as, like I said, the pandemic itself and the nature of that disease being related to bronchial tissue and the ability to breathe. So that could have something to do with that, but we'll see whether or not that changes. You can see obviously in this first quarter it kind of bounced back up to here, but in many ways you could say that this is where the real base point is. So it's actually back down to 2018 level. All right, and then there are other little presentation thing. This had some of the other charts I wanted to go. Okay, pretty picture. This was the thing we were talking about, how it had the reported shipment volume down 12%, but because a large amount of that has to do with trade inventory movement. In fact, about half of it, the overall adjusted smoking volume is actually really down 3.5% overall. This is the type of adjustment that I actually sort of agree with. I don't really understand what they mean by the calendar differences, so I'm just going to ignore that. But you could say, so my own adjustment would probably just say about -6%, but whatever. Adjusted cigarette industry volume decline rate. Obviously in the second quarter they actually had 0 decline rate. People were actually buying cigarettes like crazy, also buying cigarettes like crazy, but buying them less, and then we're sort of back down to where we were. Here, this is the charts I want to talk about, showing overall trips in millions to stores to go buy cigarettes. You can see as the pandemic started, stores closed, people were unable to go buy cigarettes, and then at a certain point people were able to start going buy cigarettes again. And before that actually began, you can see it was actually tipping up a little bit. People were preparing for the fact that they weren't going to be able to buy cigarettes, and then they couldn't buy cigarettes, and then they started to be able to buy them again. And if you look at the same point, the volumes per pack. So the volumes per pack started going up very significantly as soon as people realized they might go into shutdown. And they probably were a little late on that. A lot of those people probably wish that they'd started a little bit earlier. But yeah, and then it sort of reached a peak point around the 4.9 point, which is interesting because that's sort of the lowest amount of the trips. So you could say that like it started a little bit late, but it actually peaked roughly in line with the trips. So by the deepest point of the shutdown, people were indeed buying the highest amount of packs per trip. And then that trend started to reverse itself. It seemed like it reached sort of a low point in November to December timeframe, and then it seems to be kind of tailing back upward a little, which is interesting to see that it's tailing back upward in the volumes per trip. But it also is curious to see how, even though the total trips had peaked through the summer, it's kind of been this decline in total trips back down. And the fact that, for example, the total trips is actually declined below the original point there, that's very interesting to see. So people are going out less in total trips, and they're just buying more volumes per pack. And that seems to be the actual trend change, because it's well past the major point of the pandemic. The pandemic started to relax a little bit in its third wave hold, started to relax itself in December. And so the fact that even so, the trips are still going down and down and down through December, and the volume is going up and up and up, it's interesting to see. And then it shows also how that trend continues into the beginning of this year. It is interesting to see the total trips came down so sharply in March like that. I'm kind of curious what caused that little bump. I don't really know. Maybe it has to do with stimulus activity, but it's a little bit weird. I'm not sure. But yeah. Was that the only thing I wanted to talk about in this presentation? I can't remember. Interesting to see overall. You can see the growth rate on since progress in 2019, where they started. You can see the growth rate was really strong through all the quarters of 2020, and then technically you can see this first quarter is actually a little bit of a slowdown in the growth. Not majorly, but that kind of suggests that the pandemic was having somewhat of an effect on the growth rate. I think that's really all I wanted to look at here. Most of the rest of it in a large way is just kind of like advertising in a large way. Stuff we already talked about, just with less pictures. But one more of the details on cannabis though. Altria is obviously pushing for cannabis policy and regulation. They want to have fully federal legal, but they also want a regulated market because that would benefit them. As I said, they've already positioned themselves with Cronos to be a large player in that space, and Cronos doesn't have a huge presence in the United States. So what that gives them the opportunity to do is probably to go into a partnership with them if it does become federally legal. I wouldn't be shocked to see them becoming like the distributor for Cronos in a large way. That wouldn't surprise me in the least, and so therefore it's to their benefit to lobby for high regulation but fully federally legal. I want to make it fully federally legal but highly regulated, so that therefore larger companies such as Altria would have the best advantage for being able to do that. I'm not in general in favor of large amounts of lobbying for corporate regulatory action in the name of competitive advantages. So I mean, I'm not exactly super happy with that, but I mean, you know, it's a good business practice in the terms of the litigious culture in which we live. It's regrettable that that's the culture that we live. Whatever. And then as we already sort of talked about, their capital allocation, high amounts of dividends. They maintain an overall target of 80% of adjusted diluted EPS, and again, like they said, they expect to see their EPS grow 3.6% or so, but it is a decline from last year, so it wouldn't surprise me if their increase on their dividend was pretty small this year relative to the last couple of years. That's the thing. Even though they're a pretty highly mature company, they do tend to grow their dividend at a pretty reasonable clip, which I mean, you can see for the last 5 years, it's had a CAGR of over 10%, and that 10% has been stably growing for 5 years. So from a CAGR of 8.5% up to 10.3%, but it wouldn't surprise me if they only had it grow like a couple percentage points this year. Well, I mean, you know, it'd be nice to be wrong. I would love to have it if that were the case. But yeah, so that's Altria, moving beyond smoking. Kind of a joke, but so we'll actually look at the valuation now. If we spent, you know, most of an hour, or more than an hour, I think at this point, yeah, talking about just the industry in a large way. So people are expecting them to grow the revenues for the next couple of years. The analysts there are, that is. I have a range that's actually essentially assuming the worst. I'm sort of assuming that they're actually flat. I'm assuming that the shift in their segments is a little bit trickier, so that seems like they'll probably do better than that, but we can probably actually shift it upward slightly. Doesn't need to be shifted upward much, but that's the case. And the analyst expectations, as the analyst expectations are actually positive, but I'm sort of trying to be extra conservative with this one because of the uncertainties related to their business. So That just is what it is. I personally feel pretty strongly about their ability to achieve probably a 2 to 3% revenue growth. But because of the massive cultural tailwinds against them, or headwinds against them, I mean, then I think it's important to sort of really couch your expectations into a much more reasonable set of assumptions. I'm not sure why this is 40. That's kind of unreasonable. Yeah, so I sort of compressed the margin expectations. 40 was a little high and 5 was a little low, and then 20 was a little low for the analyst expectations. But in many ways, we sort of just ended up back where we were before we shifted the revenues and the margins. So we really didn't change much. We just kind of compressed the expectations downward a bit. As you can see here, I have the effective tax rate at 28%. They were guiding for this year of 24 to 25%, but we're also expecting corporate tax rates to move up. And they typically do pay out a decent amount of taxes. The thing about that is, it's like, on one hand, you think that like putting a higher tax rate in is being conservative, but it's kind of not, just because of the fact that there's tax benefits. So by increasing the tax rate expected, you're actually sort of increasing the value, because they can take the tax benefit from their debt. And the fact is, this tax rate that I put in here doesn't actually affect the margin. So this is the presupposed margin. It's like, if I increase their tax rate but the margin stays exactly the same, then it actually just increases the value, because it essentially means a larger amount of the expense is tax, and that taxes means that they're also getting the deductible effects. So that's essentially how that comes out. So I think we'll leave it though in that 20% range. What was that? That was about the same. Now, the returns on invested capital for the 3 years prior to the pandemic, returns on invested capital were averaging 26%. In the last year, they had a decline in their returns, like most companies, which I think it's fair to sort of include it. I'd sort of be willing to push up a little bit further, but obviously if we push it out to a 5-year average, it includes this 5% here. So then suddenly that doesn't seem as appealing. You go to a 9-year average, I think it does go up. Either way, I feel pretty comfortable including the 2020 number rather strongly. He believes their returns on invested capital around 21%, but their excess returns are still really, really high, partially because their weighted average cost of capital so low. Part of the reason that their weighted average cost of capital is so low is because, well, they have a relatively low cost of equity, relatively low interest rate, and also, like I said, they get the overall benefits from tax. I have to make 100% sure, because I feel like that still should have been maybe a little bit larger. So let me double check this. Just a second. that's the problem. I'm not sure. There might be something. Okay. Oh, okay. Yeah, the reason why, that's why. Okay. The reason why that is coming out the way it is their cash pile. Yeah, that's right. That's why. Because they're holding on to such a large pile of cash, it actually really pushes their weighted average cost of capital down, which pushes their excess returns up. So that's why it's that way. Might want to double check that later on, but I'm overall pretty pleased with that. But either way, so we're going to check on their payments to shareholders. If you look over the long run, their average free cash flow to equity, which is the after free cash flow after paying for debt, about 6.6 billion. If you look at their total common payout over that same time frame, the average is 5.4 billion. So they are not overpaying. They're in dividends, they're not, and share buybacks included. That's very good to see compared to some of the other quote unquote dividend stocks that we were paying attention to. It's something you really want to be sure of, is that they're not actually overreaching as far as what they can and cannot pay. And then another factor you sort of want to keep in mind is sort of the same thing over maybe shorter periods of time. It's like, is this getting better or is this getting worse? It appears that it's staying rather stable in those in that sort of action, so that's good to see. They're not being unreasonable in their expectations. In fact, what you could say is that maybe that belies the expectation that I implied earlier, that they probably wouldn't raise their dividends so much this year. Maybe I was wrong in that assumption. Maybe that was a bad assumption to make because of that. It's like maybe because of the fact that they've actually been technically underpaying their shareholders, that perhaps you can expect them to speed it up. Either way, we'll see. I think they announce that pretty soon, if at all. Let's see, 30 in, have to pay down debt so we can give them that benefit. But yeah, so this is pretty much what I'm pleased with overall for Altria. 5 years ago, they had $25 billion in sales. In the most recent year, it was a little over 26 billion, which is, you know, just an eking out a slight growth rate in sales. Like I said, that's pretty much what you can generally expect. My expected value for revenues movements. Oh, geez, don't mind me. My color scheme cracking out. But overall, so we're just sort of assuming they're not going to grow in overall revenues, but that's I'm pretty pleased with that distribution. We're assuming their sales to capital ratio stays about where it is, which is a little bit lower compared to their overall industry. That sort of makes sense though, because they're the larger player that's been in it for longer, so their capital has been compressed relatively to their sales. Returns on invested capital, we assume, also will get compressed over time, which is good. It's also been compressed over the last 5 years. We assume that they will take on more debt over this time frame, which is really just us being conservative, because like we said, we sort of expect them to actually pay down some debt. Hold on, I still need to adjust that. Hold on. Okay. I just pulled that up and I totally forgot about it. Like, Okay. All right, so there's the adjusted default risk that we expect. We're seeing possibly like 1.6% default risk per year the next 5 years. There are profit margins. They had 22% or so in the most recent year, and it's actually grown over the 5 years slightly. We expect it to actually get compressed. That would result either way in more profit for them, because they're generally a pretty strong cash flow machine. It would actually still be stronger than what it was 5 years ago, but overall relatively flat. So we're just assuming the business just keeps chugging at basically the same damn rate. But either way, that means with a discount rate of 6.23%, we would still expect the present value to be $59 as of today, which is 23% undervalued from the current price of $47.87. And we expect 5-year forward target to possibly be around $80, though ranges anywhere from basically the same price, which again, like I said, that's a very strong protection of downside, versus the high end possibility of it really skyrocketing to 147, not really on the backs of cigarettes, but maybe the oral categories, and then maybe cannabis legalization and licensing and other such great boons to their business. But either way, that sort of assumes about a 10.79% per year return for the next 5 years. And they're currently eking out a dividend of over 7%. So really, you're going to be getting the dividend plus about 3% of share appreciation, which will keep you nice in line with inflation. So you just want cash, and to keep up with inflation, Altria is probably the perfect stock for that. In many ways, it's like the perfect dividend stock, but it does come with secular decline issues. And then the multiple regression output comes up with options kind of all over the board, partially because of their highly profitable and highly return oriented business, but also with some of the secular decline effects that makes the market somewhat pessimistic on them. But overall, in balance, it comes out rather even. It's only a little bit lower than the current price, so I guess you could say that the market is really choosing to assume exactly what it wants to with this stock. But yeah, that's Altria. Pretty pleased with that. Like I said, it's one of the ones in our portfolio. We've had it in our portfolio for quite some time. We don't really expect crazy returns from it, but it feels like it would be a waste to sell out of it because it still has just good cash. So move on to the next company we're going to be doing today. We're going to be spent more time on Altria than I really wanted to, so we'll probably actually have to go a little bit faster than I was really originally intending for this. But we're also going to do Royal Dutch Shell now. We're not going to spend nearly as much time on their presentation and stuff. Because frankly, I don't think explaining their business is too necessary for Shell. Most people understand what gasoline is, and natural gas, and other petrochemicals. But part of the reason we're doing these two companies today is because they do have something in common, even though they don't seem nearly as in common as what we did on Monday, where we did literally two different pharma and biotech companies. But now we're sort of doing two different secular decline industries, I guess you could say. Two industries that are perceived as moving downward by the market. Obviously, there's the large narrative against internal combustion engines that goes on in the investing community. It's all Tesla, electric. But a lot of people sort of ignore the counterfactual dynamics that works between that, which is to say that yes, in the long run, we are likely moving towards a 100% electric vehicle future. But the real question is just how long it's going to take to get there. Most of the Tesla bulls have assumptions that it's like within 5 years the majority of cars will be electric, or maybe it's within 10 years. I'm just not that optimistic. I really think it's closer to like 20, maybe even 30, because there's a lot of cars on the planet, and not everyone can afford Teslas. It's like really the majority of Teslas are sold to Californians or relatively rich Chinese people. That's where the majority of Teslas are sold currently. And the thing about that is that you sort of have to think about what makes a substitute product more appealing in the microeconomic sense. For a substitute to become appealing, the price of the item it's substituting has to go up. So when a lot of the electric vehicle people were sort of celebrating the decline in oil prices last year during the crisis, being like, see, this is proof of concept. The electric vehicles are taking over because oil is crashing because everybody knows the oil's going down. It's like, no, you sort of have to remember that the cheaper the oil prices, the cheaper it is to operate an ICE vehicle. So really, if you actually want more Teslas on the road, you need high oil prices. So if you have expectations of being able to shift fully to electric, then you have to realize that for like the at least like half of the run-up period, it's actually going to be preceded by high oil prices. In fact, when did a lot of the action in electric vehicles start to take place? Well, that was during the time when oil prices were starting to skyrocket through the roof several years ago, which was also what led to the shale revolution, and which then led to the subsequent crash in oil prices. But not really. Why are my charts all split? I do one basic little thing on this. That's it. But yeah, oil prices being up near $100 a barrel like it was during 2012 to 2014 is really what I would say led to a lot of the Tesla ramp up during this period. Yes, the oil prices then declined massively back down, dropping down into the 20s ever so briefly in 2016 before climbing back up to the most peak levels of 75, and then pre-crisis we had sort of 65 range, I believe it was, or 62 range, and then now we're back up to close to 65. But the point is like this part of the growth is much more indicative of Tesla's ability to continue pushing high. We had the super negative prices. So that's just something to keep in mind, that if you want to make the shift to electric vehicles, we actually need high oil prices, which means that shareholders of oil companies will be benefiting from that transition for quite some time. And understand that over the long term, as the vehicles get adopted, yes, oil prices will then start to go down because of the lack of demand. But the point is the supply will likely move down faster than the demand, and because of that, the price will be managed. And so that's something to keep in mind. Obviously, Shell spends a lot of its time trying to convince the market that it is moving away from oil, which is not really exactly something that I consider to be strong. It's like really, I think it's kind of pathetic in some ways. You really shouldn't, like, companies that feel the obligation to diss on their main products are faced with a lot of problems. It's like you're sort of fighting yourself. I mean, this is true with Altria too. I mean, how much of their presentation was talking about, like I said, the smokeless future, and it's like that. It's like you're basically just dissing your own main product. At least with Altria, they actually have the alternative product in their own ecosystem. So when they're trying to argue that they're getting rid of the smokeless product, that's because they're trying to shift you to to the smokeless product, but they're not trying to go to a tobacco-less future. They're trying to go to a smokeless future. You'll see that's the difference. And with Altria, they're not trying to get you off of tobacco at all. In fact, they hope that everybody maintains addicted to tobacco as long into the future as possible. They just want to get rid of the combustible products because they understand the health concerns related to that. It's not like they've had some mea culpa related to the fact that their product is addictive, right? But with Shell, it's a little bit different because they're trying to argue for renewables, but in my opinion, their quote unquote renewables that they have within their ecosystem is more for show than it is true confidence in that actual product evolution. So that's just something to sort of keep in mind, that there's a lot of arguments essentially about how genuous are they trying to be about this. But either way, my position in rds.shell has less to do with confidence about the actual company and their own governing structure relative to many other companies I might be invested in, and has more to do with the commodity. That's the thing about commodity companies. I mean, this is sort of a dynamic that you see with a lot of companies, is that the smaller and the younger a company is versus the larger and the more mature a business is, sort of affects which details are most important to the valuation. With a young company, a startup company, or just a growing new industry company, it actually has much more to do with the story surrounding the stock than it has to do with the finances. And then the older and the more mature a company comes, it actually ends up having more to do with the actual finances and less to do with the story. And how that plays itself out is that with young companies, you really want to focus on the CEO, you really want to focus on the board, you want to focus on what vision they have for the company, and things like that. But for the larger and the older a company is, and the more mature the business it is, it actually almost doesn't even matter who the CEO is. And this is, in a large sense, doubly true for commodity companies, because when it comes to commodity companies, it's basically all the commodity, which we'll get into how we play that out into the way we value a commodity company, because it's actually extremely different from the way we come up with the cash flows for pretty much any other company. Again, we'll get into that. I'm sort of just kind of looking through some of these things. We're not really here to go in depth into this presentation like we did with Altria Group, but we do want to sort of at least look at a few of these things. I just kind of wanted to make sure I wasn't missing anything super important. Like I said, we're primarily going to look at the spreadsheet for this one. But here it is. You can see what I mean with this. They're using the stakeholder talk, stakeholder capitalism, which is definitely a cultural shift, an idea that's been kind of growing within the investing space, that it's companies ought to be paying more attention to all stakeholders rather than shareholders. The concept being that stakeholders include employees, they also include the people who live in and around your business, they include the local communities and things like that. And all this has to do a lot with ESG strategy, which, like I said, with Altria, I'm not really very fond of the ESG culture in a general sense, but call me a hardcore capitalist, I guess. But anyway, this is one part we did want to show. As you can see, they do have multiple segments, but this is sort of what I mean by their overall transformation of the business, because they have the oil products, which really makes up the vast majority of their business, but they also have a chemicals product, a chemical processing part of their business, and that part that part is sort of where they're fitting in a lot of this supposed transformation on the belief that supposedly they're going to shift away from oil products and more into refining. I wouldn't be surprised if they actually shifted this business into this segment in the future. And then while the integrated gas is really part of the oil products, it's just kind of the production and the exploration separated out from the distribution. That's kind of like the thing about oil companies is there's generally thought of to be sort of like three segments of the business. There's the upstream part of the business, which is essentially the exploration of the various areas as we had on that map here somewhere. Oh, well, this is their divestment map, but I wish they had a map of the current properties. Maybe they don't have one on here because they're not proud of it. That's part of the problem. See, there's nothing really quite so worse than a company that's not even really proud of its own product. You know, that's sort of what I mean by like the whole stakeholder thing and their lack of confidence towards their own transformation. At least with Altria, like I said, they're moving away from smokable products, but they're still sort of proud of the tobacco part of the business. But with Shell, it's a little bit of this gross thing where they can't even proudly wear the oil badge on their own shoulder. And I mean, you know, a lot of people have different views on that. The global warming aside, you know, in my opinion, it doesn't really matter what your views are on global warming. Hydrocarbons are an absolutely necessary part of our life. They're an absolutely life-saving business as far as I'm concerned. It's like you can take the gasoline of vehicles completely out of the equation, and it has basically nothing to do with that as far as I'm concerned. Because look around you, honestly. Look at all the plastics. Look at all the other oil-based products. Look at the way we generate power and the way we actually back up our power systems. Most people don't understand this. They sort of think that, you know, when it comes to like renewables, all we need to do is just shift over to solar and wind farms and all these other things. But people don't understand concentrated versus disparate power generation, as well as intermittent versus constant power generation. So the truth is oil is not going anywhere. Even if we replaced every gasoline vehicle on the road, oil would still be with us for 50 to 100 years after that. It would just massively lower the amount of oil that we use, but it would concentrate the types of oils we use. Because while we might have an alternative, a substitute for internal combustion engines, we do not have a substitute for plastic, and we're nowhere near coming up with one. So doesn't mean, you know, we should be throwing plastic in the ocean. No, it's not an argument that everything that happens with plastic is morally good, but it is an argument that every hospital generator in the world still keeps a gasoline backup, because they need to have gasoline backup because electric lines are not reliable, windmills are not reliable, solar farms are not reliable, but gasoline is reliable. It's the most reliable energy source on Earth, outside of, I'd say, maybe nuclear, which obviously has all sorts of its own problems. But I mean, I'm actually super pro nuclear power. I think it's ridiculous that our country isn't like 95% nuclear power. But that's just me. That's different discussion altogether, and I have a different position in the portfolio that is tailored toward that. It's like, if you ask me, it's like you want renewable energy. We need to go for nuclear. That's the real answer. But anyway, so we'll get into what I mean by how this is different, because it's much more about oil prices. I don't know how many of these valuations people may have paid attention to. There's all these little pages down here, but one page that we barely touched on is this technical page. Only time I've ever really come over to it is if maybe this Google Finance thing wasn't actually putting in their price data correctly, so I'd have to kind of reset it. But this whole section over here is specifically for oil companies. Well, not oil, for commodity companies, because this applies to mining companies, lumber companies, any company whose main product is a commodity that in itself is also a tradable asset. We basically have to take the potential changes in the price of that commodity into account when we're trying to project the revenues. because for most companies, what I do with my revenues, as maybe you've seen, is we take a look at, industry expectations, analyst expectations, overall trends in the economy, and sort of come up with a worst case scenario and a best case scenario. And then we also put in an analyst number, and then we sort of just let the quartiles sort themselves out on that, and then we distribute the quartiles according to our own expectations. That's generally how we've operated here. But this little bit here that asks whether or not we're using a driver is exactly what we're talking about. Is that with commodity companies, the revenues are being driven by one key macroeconomic figure, which is the commodity price. So that's what we do here. I have this other spreadsheet with oil prices where I do a variety of other analyses of oil prices and what I expect out of them and things like that. But that information is being ported over to this spreadsheet where we have the oil prices coming in for the last 30 years at the year end price. So we're just using one price per year. You could do this to a much more detailed level. You could use daily prices if you wanted, but I just didn't want to go to that exact extreme. But either way, we also put in the Shell price at the same date, and then we run a statistical regression. It's pretty much as simple as that. We come up with a best fit line, which comes out of here, and essentially based off of a 30-year average, which 30 is in statistics generally thought to be a base minimum for a representative sample. So that's why we use 30. You really just want to have a 30 minimum. Sometimes you don't have 30 because sometimes you just don't have that many numbers, but that is what it is. And then if you essentially look, you see, okay, oil prices versus the price of Shell, you find out that there's actually about a 75% correlation between the price of oil and the price of Shell. Just those two things. You don't need to look at margins. You don't need to look at revenues. You don't need to look at anything. You don't have to look at tax rates. You don't have to look at debt, nothing. You could almost just invest in Shell purely based on that. That's the interesting thing. And a lot of people do these same things. There's plenty of traders that do stuff based on that, and it can shift up and down. And with some commodities, it can be a lot stronger or less. With you can see here, there's a standard error. So 75% correlation. It says that based off of the current oil price, you would expect the price of Shell to be 61.27, which has a standard error of 8. So perhaps you could see it being up or down $16 in either direction, which on the downside, that's not the worst. That's like 45, which not that much down. In fact, it's actually up from where it currently is. And then on the upside, that would be 75. So that would just be even further up, right? But there's also another way to look at that. So that's correlating the price of oil against the price of Shell. But you can also correlate the price of oil against the revenues of Shell, which for some commodity companies, one might be more correlated than the other. In this particular case, you can see right here that it actually shows that the correlation is stronger for the price of each directly versus the price to revenues, which comes out with only about a 51% correlation. But the thing is, in real world economic facts, 51% correlation is actually pretty strong. It's in a math class, in a statistics class, it's not very strong. You're always looking for something that has like no more than like a 5% standard error or something. They always have high expectations for those perfect little math problems. So, but in the real world, getting a 51% correlation is honestly pretty all right. That's just the truth. But like I said, I look at both, and depending on the scenario, I might even that's the things. I will do my valuation based off of the revenues, and because that will play itself out into the rest of the spreadsheet over here. But you can sort of take this as an extra piece of information. It's just, I guess you could say, the cherry on top. So what we do, this is a little bit complex here. I take, like I said, we have the oil prices from the history. we have the oil prices from history, and I also have projected oil prices based off of the growth in the money supply, which is a method that I use for projecting the prices of commodities for a variety of things. I do this for gold, I do this for silver, I even do this for Bitcoin. I think it works especially well for those types of monetary commodity assets. It doesn't work quite so well for productive assets like oil, but I do think that it still is somewhat relevant, but I try not to rely on it as strongly. But then we combine that with, like I said, all the oil prices for the last 30 years here. If you order them based, you should put them in direct order, not based off of what year, and then you put them into quartiles, and then I take the average of each quartile. So basically the bottom quartile of oil prices over the last 30 years is average about $27 a barrel, and then the second quartile of about 40, then 50, then about 64, then about 95. And then so I use those, I replace a couple of the top ones, two of the top ones, with, like I said, some projected oil prices. So I assume that on the about 40% of the top end, that there's potentially more upside than the past is showing, because the past is the past. And that's the thing is, people say it in investing all the time, right? Past performance is no guarantee of future returns. That's like the classic line you see in basically every investment report and in every company's 10K. It's the commonly quoted thing. Well, it's true about commodity prices too. It's like we're sort of using the statistics of the past to project the future, but point is the past doesn't always include enough information to tell you about the future. So I'm also including a little bit of information, like I said, from my own assumptions about the fact that commodity prices ought to move upward in tandem with the growth of the money supply, which, like I said, that shows itself out a lot more strongly with certain assets like gold and silver, because, for example, I did a correlation between the money supply with oil, and you can see the correlation of the money supply with the growth of oil has actually been about 62%. So it's actually stronger than the correlation that existed between the revenues, but it's not as strong as the price correlation between Shell and oil itself. Just for a comparative basis, let me pull out my gold spreadsheet. Come on, please don't do this. Okay, pull out the gold spreadsheet. You'll see that the correlation between the growth of the money supply and gold is 90%. Which, I mean, like I was just saying before, even getting a correlation in reality higher than 51% is pretty great. So gold has like a damn near perfect correlation to the growth of the money supply, which is it's not me telling anybody to go do anything about gold. We haven't covered gold or gold miners on this channel yet, but we'll get to them. But I mean, if you want to make your own assumptions about my thoughts there, you can probably figure it out. But either way, back to oil. So the point is, I do want to include projected prices of oil. That's essentially what the argument is. I'm using I have projected oil prices here, which is all pretty high, mind you. Again, the price of oil right now is like $65 a barrel. So the fact that this is assuming that the growth rate of the money supply stops entirely. It basically assumes that we literally for the next 5 years do not grow the money supply, which is patently insane, unlikely to happen, absolutely ridiculous. We haven't had a year without money supply growth in probably like, well, all 50 years since the petrodollar came into existence, because actually this year is the 50th anniversary of our current currency paradigm, incidentally. I believe it's like the anniversary is like in October or something. But either way, so we anywhere between, and the growth rate for the last 40 years has been about 8% per year in the growth of the money supply on a compounded basis. So I'm basically assuming that anywhere between 0 and double that is the growth of the money supply for the next 5 years. Last year it was quadruple that, mind you. So the idea that I'm assuming it grows double is not unreasonable by any stretch of the means. And if you have any knowledge of unfunded liabilities related to the national debt and our deficits and all of that, well, and especially also the political plans of the parties in power, then it's pretty clear that it's not unreasonable to assume that we could have massive money growth like 16% per year for the next 5 years. But even so, like I said, I'm assuming that maybe it doesn't grow at all, which that I would say is impossible. This I would say is very possible, just not necessarily a majority likelihood, but it's probably 25 to 35% chance that that occurs. This 0% chance it occurs, but I'm still weighing it in. I'm still weighting it in regardless. So that's me being conservative. And either way, that means I come up with sort of an average expected price of 145. So I'm using that price along with a couple of the idiosyncratic prices within. So I'm using the quartiles along with a couple of the higher end prices to come up with 5 possible oil prices to distribute my expected revenues based on, and then I plug that oil price into the best fits regression that I have to come up with the revenues that I would expect based on that oil price. So essentially, if I get a $27 oil price, I would expect Shell to, in 5 years' time, have a $273 billion revenue. And if they had $197 a barrel, which would be all-time highs for oil prices, then I would expect them to have $628 billion in revenues. So that's essentially how we do this. We use a statistical regression of the commodity price to project potential revenue outcomes based on potential oil prices, which, like I said, it's just very, very different than how we approach revenue projections for every other type of company other than commodity companies. And the reason why is because, like I said, you just have to look at the statistics of it. The price of the stock is 75% oil. It just is. And like I said, with gold, it's usually even more. So and that's just other examples. Like I said, you could do this with lumber companies, you could do this with iron companies, you could do this with lithium companies, any commodity company. It works just as well. I mean, assuming your correlations are reasonably strong. If you have weak correlations, well, then maybe you shouldn't do that. That's just the truth. You have to see what the regression actually comes up with before you make that true decision. But then based off of those oil prices, I then take those oil prices, I plug them in to here, which is sort of a similar thing to this little piece I put right here, but it's just kind of over here. And then I sort of work backwards from the revenue growth based off of what the most recent price is to come up with what that actual growth rate is. So it's like, this is the end revenue, and then we have the starting revenue, and then we can kind of, calculate backwards to find out what the compounded revenue growth expectation is. So we have revenue growth expectations across the board, and distributed to be about 15% per year expected, which is pretty crazy growth. But again, that's just because oil prices are crushed right now, and there's not really a high reason to expect that to continue, especially with high deficit spending, expected economic growth, money printing, and the compression of oil prices from the last several years to begin with. So it's been quite some time since we had peak oil prices. What was the peak? Yeah, around 145 or so. But one thing that we also do differently in this case is, like I said, whenever I'm using a little bit more of a subjective approach to trying to come up with revenue projections for other companies, we also then distribute those outcomes based off of kind of our own personal feelings and sentiments surrounding each potential outcome, which I usually try to make look a little bit like a normal distribution, and then I just assign about 1/6 of it to the analyst. Is generally how I approach that. I start with kind of a normal distribution kind of approach, and then I might shift the tail towards the negative or the positive end depending on my own sentiment. But with commodity companies, I don't do that either. I actually just leave it completely even because we don't really know. We don't know what the oil price is going to be, so we're not making any assumptions about the oil price. We are equally as assumptive that it's going to be $27 a barrel in 5 years as we are that it's going to be $197 a barrel. We're not making any assumptions. The only part that, like I said, we're making assumptions is that we're including two outcomes that assumes that oil does correlate with the growth of the money supply. But I mean, 3 out of the 5 have nothing to do with that and actually have to do with historical prices that were literally some of the lowest prices in the last 30 years. So for 40%, we're being optimistic, but 60%, you could say we're being pessimistic. And then we do have an analyst line still put in there. But what we do for the analyst line is I actually just go look up what analysts are projecting for oil prices, because yeah, you know, I mean, analysts project commodity prices too. You can go find those results. So you can that basically, that's how we get our revenue distribution. Now, so this is actually irrelevant. Like this right here doesn't actually change the valuation because we're not actually using it. That's just kind of numbers that are put in there, because like I said, we're actually porting this over the formula here that essentially ports the numbers over. So essentially these percentages here don't really make a difference. It's actually what comes over here, which this is another part of the, we've looked at this sheet for many other companies, and there's this one column right here that we've basically never talked about because we haven't done any commodity companies yet. We've basically just moved right past this column. Every time it always says NA, 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 NA. That's because there is no specific sales driver for Altria Group. They just produce and sell cigarettes, and I guess you could say tobacco is a commodity, but it's not really a traded commodity in the same form. I mean, it used to be hundreds of years ago, but not really anymore. It's just produced on farms by a select group of companies primarily. But for RDS.a, the way we do have the sales driver group in here, and then we do show what our oil price assumptions are for each potential outcome and how that plays itself out into the outcome, and also shows the expected value. So our actual expected value based off of the probability distribution of these oil prices is $82 a barrel. We're assuming in 5 years time oil will be $82 a barrel. Again, it's like 65 now, so that's like a 25% increase in oil prices expected over the next 5 years, which I would say that's not unreasonable, not at all, especially since 82 is not anywhere near peaks. And like I was arguing earlier, for the transformation from internal combustion engine vehicles to electric vehicles to occur, you need oil prices to be high, because high oil prices means high gas prices. High gas prices means that the marginal cost for each consumer to keep using their internal combustion engine is higher, and that makes the alternative of buying an electric vehicle much more appealing. If it's because, you know, it's not just that you have to buy your $10,000 car, you also have to buy oil all the time. So if oil is $100 a barrel and you bought a $10,000 car, well, then the actual costs for you to operate that vehicle are going to be extremely high. And, you know, Elon's out there trying to push his vehicle prices lower, and that's probably going to take some time for him to do that, much longer than probably the market generally thinks. But the truth is eventually those lines will meet, and eventually the marginal cost of driving an electric vehicle will be cheaper than the marginal cost of operating an internal combustion engine. But right now, that's just not the case. So, and the only way for that to change is for oil prices to actually go up, which means that at least in the next decade, for electric vehicles to even be viable, it basically inherently means that oil companies have to be reasonably successful. That doesn't mean they're a bargain, because again, a successful business is not the sign of a successful investment. There's many other factors that go into that. There's a reason why I'm in Shell over, say, Chevron or say Exxon. You know, they're still choosing a company base that's cheap. And again, we haven't covered the rest of this. We're still kind of getting into it. I've spent all this time just explaining how it is we come up with revenue prices, because again, for a commodity company, 75% is the commodity. Well, for this commodity company anyway. So anyway, we'll continue further along, showing how, explain sort of a bit about the margins. The margins is a little bit more of a stab in the dark, similar to how we handle most other companies. We kind of just look a little bit like their historical range of margins, and also think about what the ways they're trying to expand their business, and then really just kind of play with a worst to best case scenario. We do have to do it a little bit differently when it comes to commodity companies, because we're not using the distribution in a way that allows us to tailor it for our own expectations. So we have to specifically try to tailor the margins in a way that is distributed evenly, which is a little bit tricky to do, which is part of what I have these other pieces in the technical page down here. Like we have this margin section up here, and I have this other section for trying to kind of estimate capital ratios, and also another section for margins, which is a little bit messy. Like I said, it involves some of the information that they don't actually have in their quarterly report. They only do it in their annual report, which is a lot of the ASIC numbers, which is basically the average invoice cost for each barrel. Essentially, they can produce oil for about $35 a barrel. Like I said, it's about $65 a barrel. Just sort of for like a sense of scope, it's like a lot of shale companies have higher costs per barrel. It might be like in the 50s to 70 range. Aramco in Saudi Arabia, they, for example, one of the reasons that like people talk so much about Saudi Arabia is that they have basically the lowest cost of production for oil. In Saudi Arabia, it's like something like $20 a barrel is what it is to produce oil there. So I mean, think about it. Like if we have $65 price a barrel, that means that the Saudi prince essentially gets to collect like almost 70% gross margins on oil, which is pretty outstanding. I mean, in Saudi Arabia, I mean, the oil is so easy to get out of the ground. You can practically just walk out into the sand and push your hand into it and watch oil come up. I mean, exaggerating a little bit, but in some ways not. Versus this is the thing, not all oil is the same, not all commodities are the same. Different commodities require different costs in order to get to them. Shale requires massive technological innovation and digging and drilling in order to break it open. Digging for oil in the Canadian tundra requires massive capital investment in order to dig under the ice, and cleaning the oil out of the oil pools in Venezuela requires submersion equipment and also high drilling capital intensity, again, but versus places like Saudi Arabia and much of the Middle East. This isn't just Saudi Arabia, but Saudi Arabia does have the cheapest. But I mean, this is part of the reason people fight over the Middle East, because the costs of getting the oil is so cheap relative to other places. Not even that they have the most oil. In fact, Venezuela has actually the most oil. That's actually where the largest untapped reserves of oil are on Earth, and that's actually part of the reason that there's so much political strife, both in Venezuela and surrounding it. Has a lot to do with that. I mean, there's a lot of other factors that go into that, socialism and other such things, but part of the reason that Venezuela was so wealthy several decades ago and then had their economic collapse has very much to do with collapse of oil prices. So, like, just so happens that Venezuela's economy collapsed right here, and then again right here, and not a coincidence. That's all I'm saying. Because like 70% of their economy was based on oil production, and they didn't divest it. And that's actually something that economists often talk about. It's like the what's it called, the paradox of resource or something like that. I might be getting the wording slightly wrong, but it's basically this economic paradox that you generally see. It's a generalism. It's not 100% true, but in general, companies that are actually the most natural resource endowed often have some of the worst economic conditions, and it often has to do with geopolitics and the way other nations want to take advantage of those natural resources as well, and imperialism and a lot of other factors. But either way, let's not get too distracted away from Shell. Just trying to explain the oil market, I guess. But I mean, like I said, understanding the oil market is incredibly important to understanding the stock. So I guess you could say there isn't really too much that I can spend on trying to explain the oil market, because like I said, I would rather spend an hour explaining the oil market than even spending 5 minutes telling you the name of the CEO of Shell. First of all, I can't even pronounce his name, so that's that might be part of the reason why I'm not talking about it, is I don't want to make a fool of myself by mispronouncing the Dutch dude's name, because it is a Dutchman with a name that I often pronounce wrong. But I'm sort of kidding a little bit about that, but it's true. It's like I said, if he retired tomorrow and a new guy got hired, I wouldn't even blink. Versus if Elon retired tomorrow, you know, Tesla would crash 90%. You know, so there's the difference. The different companies, the CEO matters. Other companies, CEO doesn't matter. And when it comes to Shell, doesn't even matter. It just doesn't even matter, because what matters is how many millions of barrels of oil do they have on their balance sheet? How much reserves do they have? How much potential they have, which comes into some other factors. So anyway, like I said, in their annual report, we do have to look into finding out what their cost of production are. We do have to look into how much reserves they have, how much unconfirmed reserves they have. It's like how much potential reserves they have. But we use their cost of production relative to the expectations of the oil prices for each outcome to come up with an expected capital need for each of these outcomes too, which is essentially what we're coming up with right here. And then also we use the same method to come up with a series of potential margins based off of those costs of productions as well. And then we basically use those when we do it over here, though I also will adjust it a little bit for my own expectations, because this method is crude at best. I will definitely admit that. It's like the revenue method is very solid, I think, and statistically sound, but using that same method to try and extrapolate it over to capital ratios and margins is, you know, iffy at best. So I don't hold that very strongly. It's not something that it's like a ride or die factor, but I'm willing to kind of manipulate it a little bit and kind of like play with it, because like I said, for example, the revenue expectations I feel here, it's like the low end, I have it saying maybe about 1.24% margin, all the way up to maybe about an 8.97% margin, but what I actually put in is 0% and 10%. So it's like I kind of allow it to vary a little bit further from that. And like I said, with a lot of companies, I look at sort of their historical averages and stuff, and you can see like historical average for them is 3.12, but that's including the massive loss from last year, which has partially to do with just massive impairment charges that they took to their asset base. They're essentially writing down the value of their underdeveloped reserves, which, you know, it's not like they threw the reserves in the trash. They still own the reserves. They essentially just on paper chose to recognize that it's not worth as much. But that was not worth as much based off of the incredibly low oil prices that we had last year. Again, we literally went negative for a day, which is theoretically impossible, but obviously in reality wasn't impossible. For one day out of the year last year, they were effectively paying people to take oil. The reason why is because of the pandemic. They basically ran out of storage space, effectively. It's like oil, the vast majority of already produced oil is actually in motion at all times. It's basically on tanker ships being carted around the ocean. It's basically moving from wherever it was produced to wherever it's going to be consumed, and it doesn't usually exist in like a warehouse somewhere very long. I mean, first of all, oil can't actually even sit for that long. Anybody that's ever had like a can of gasoline in their garage would know that. So it's like it does move itself, but the point is the tanker ships are very expensive to operate. So for literally like one day out of the year last year, the demand for oil had dropped so low relative to the supply that the tanker ships were being paid to take the money, or to take the oil. Something that would be theoretically impossible, but did actually occur for one day last year. But anyway, I'm all over the place with this. Like I said, the fact that you value commodity companies so much differently than other companies means I really have to spend a lot of time kind of explaining the methodology and the thought behind it. It's like the theory behind commodity companies is a little bit more intense than a regular valuation, but we're trying to turn it into a normal valuation, because I mean, like I said, and in some senses this is all overkill, because like I said, we have a 75% correlation of oil prices. So in some senses I could just invest in Shell and just be like, you know what, whatever, it should be $61 a share because because of the oil price, and it's 75% correlation, and that's enough. And in some senses, that's true. But my job is to do due diligence and to actually try to think about how that affects the nature of their business, and not just look at a chart and see that oil and Shell are highly correlated. But anyway, so like I said, the margins expectations were what, 1 to 9%, and I kind of expanded a little bit outward to 0 to 10% on the assumption that could go a little bit wider. And I sort of assume that if oil prices really did go down for an extended period of time to $27 a barrel like that, well, effectively they're going to go out of business. And the reason why is because that's lower than their average cost of production of 35. So it goes to that point. As far as I'm concerned, they're bankrupt. Because again, this isn't like this is the margins 5 years from now is how I'm projecting it. But when you create the value, when you actually put the equation through, this projection becomes in perpetuity. Whatever your terminal value is in evaluation, all of these endpoint numbers are perpetual. They're going to go into the future forever that way. So you're essentially assuming that, if you decided to give them a positive margin here, even though their ASIC cost is below the also perpetual oil price that you're assuming, because that's what we're assuming here. So we're assuming a perpetual oil price. Obviously, oil prices are never perpetual because it's a traded asset, but we're assuming that under this circumstance, that's essentially what we're doing here. It's like these are possible perpetual oil prices, and these is possible perpetual margins based on those oil prices. And so therefore, if it's lower than their ASIC, they're out of business. Then there's basically no other way to put it. So 0%. And since I push it down to 0% that way, I decided to push it up on the upper end too. So up to about 10%, which is, just a rough number. I like even numbers. It's just an estimate because, like I said, the fact that we're using multiple outcomes and distributing it, that's the thing that gets you the accurate valuation. It's not the specific number you use. It's the fact that you're not tying yourself to one specific outcome and you're instead thinking about it probabilistically. This is the thing that most people don't get right about stock valuation in a general sense, is that you have to think probabilistically because the future is probabilistic. So if you're trying to think about anything in the future, you'd better be thinking it in those terms. And then as far as the analyst projected number, which I also have here, that's sort of based off of, like I said, we have the analyst price expectation there, by the way, which is about $62 a barrel. I didn't actually mention that before, but that is what they are projecting currently. And that's actually not a 5-year forward projection, by the way. There is no analyst projections for 5 years forward. That's actually only 1 year forward. So you could say that the analyst model is also being conservative, because that's the only information we have. But based off of that price, we would theoretically get about 2.93% margin, which again is a little bit on the underside because it'd be a little bit higher than that. So I actually pushed it up to 4, but maybe that's a little bit overborne. Let's go maybe 3.5. It's fair. I'll make that adjustment. Okay, so we finally got through margins. So much to talk about. And then one slight other thing that I also have to do differently with Shell, which isn't really particular to commodity companies. This is just the fact that they're a Dutch company, and this is also the A class share, because there is an RDS.b, the B class share, and the primary difference is really just the exchange upon which they're traded. The RDS.b shares are traded through the Netherlands exchange, while the Class A shares are traded in London. And there is a discrepancy in the tax treatment between the two. But it's tax treatment on the capital gains figures for each country, and then also the United States has different agreements depending on which shares it is too. Which on one hand, I'm happy I have the RDS.a shares, but there's another part of me that wishes way back when I got into this stock, because I did get into it quite some time ago. I kind of partially wish I had the RDS.b shares, but in the long run, I'm sort of happy where I am now. It's like when when I first figured out this detail, I had already bought the A shares, and I was kind of like, oh, you screwed up. And that's because at that point they had a much higher dividend before in 2019. Before that, I mean, they had a really large yields, like 5%. And then they massively slashed their dividend last year because of the crisis. And I mean, they use that as their excuse. Partially, they're just rebasing it, as they had said. But so the point is, because of the different tax treatment between capital gains and dividends, essentially the higher the dividend play, the better it is to be in the Class B share. But since they slashed the dividend rather significantly, it actually, in the long run, I guess, makes it pretty all right that I chose the Class A share. But that was really just a screw up on my part initially. Like I said, I bought this stock much more earlier on, when frankly I didn't know nearly as much of what I was doing. So when I first discovered that detail, I was like, ah, shit, you should have gotten the Class B shares, because now you're getting worse tax treatment on your dividends. But then they slashed the dividend level, so it's like, oh, well, I guess that negative kind of got minimized a bit, at which point now I'm sort of happy I have the Class A shares. But then on that front, it's also an ADR, which is an American depository slip. This is, like I said, the Class A shares, but I didn't buy it off of the London exchange. I bought the American depository slips that trade on the New York exchange, which is basically to say that there's shares in London that are set aside so that other shares can trade in New York. And like, you know, lots of foreign companies do this. It's like the dream for a foreign company is to be traded on the New York Stock Exchange, because it's the big exchange, right? So it's like a foreign company will do this. Like there's many Chinese companies, for example, have ADRs in America so that they can be traded on the American exchange. Alibaba, for example, just one good example that's often talked about. But yeah, so Royal Dutch Shell has their Class A shares are of ADRs in the US, and then they also have it's like a weird distribution between it, because it's like 2 shares, 2 ADSs per normal share, and then, like I said, the normal share A is about half of the shares of the total pile, which is the combination of Class A and B. So figuring out the total share count relative to the ADS is a little bit weird, and you have to then divide the value by 2 to actually come up with the proper value. It's a little bit weird, but that's just something that a lot of new people in the market might not realize. It's like when you're looking at share count, sometimes that's not as obvious as it seems, depending on where the company is from and how they've divvied up their shares. But anyway, so as I said with the margins, we use kind of a sort of similar method for the sales to capital ratio, which again, we're being a little bit loose with it. We have sort of the expectation that it could be a 0.76 of sales to invested capital versus 2.12. And I actually push it downward on the worst case scenario to about 0.5, because I assume that under the circumstances of, like I said, that they're actually taking massive losses year over year, over and over and over again. Well, then I'm going to assume that they're actually probably going to be writing down their asset base pretty significantly, and that their sales are fleeing to the substituted alternative, as we were talking about. So I actually assume that it'll be significantly lower than 0.76. I choose 0.5, which is a conservative choice. And then it was also higher than 2, and I'm actually using only 2 as my cap base, because I'm sort of assuming that even if they do get really high oil prices and therefore huge revenues, the thing about that is that they're also still going to have to make massive capital investments in order to pull the oil out of the ground. Because, like I said, you know, not all oil is equal. It depends on where you're getting it from. So that's just one other area in which I would say that we're trying to be conservative, but in some ways, I don't know. I mean, maybe you could argue that I should maybe even put it a little bit lower, but I mean, we can play with that a little bit, see what it kind of does. But that does make a huge difference to it. I don't want to penalize it too much. That's the thing. There's a different, you know, there's a fine line between being conservative in your estimates and just punishing a stock and therefore getting the wrong value. So it's like, I don't want to punish it too much. That's the thing. I'm already punishing it on the low end. I shouldn't necessarily punish it too much on the high end, you know? Usually if I punish it on the low end, I might be generous on the high end. So I'm going to punish it greatly on the low end and then just punish it mildly on the high end. And then as far as the analyst expectation, I'm actually just going to assume that they maintain their 3-year average, which, considering last year, is perhaps too conservative. It would perhaps be even fairer to assume 1.25 as the average, because that's the average of the 3 years prior to that. But I'm going to use that too. 1.15 is fine enough for me. And then, well, their debt levels. For most companies, with the uncertainty of what they might do with their debt, the truth is most companies don't pay down their debt. No, that's just not likely to happen. There's no real reason for them to. Companies exist in perpetuity, assuming their business continues, and therefore there's no real reason to assume that they get rid of all their debt, because it's just free financing. You can just keep servicing the debt and keep rolling it over. But they do have generally pretty good credit relative to the dynamics of their industry. I mean, they don't have the best credit compared to some of the biggest companies, but considering the volatility and the risks associated with their business, they do have good credit. But that has partially to do with just the overall size that they have. But either way, so I'm assuming that on the best case scenario, they actually only get rid of about a third of their debt, when usually for most companies, I generally assume something closer to like half. It's like I said, you can't really, it's hard to know what their company's going to do with their debt, and they're most likely just going to keep their percentage of debt about the same. Is what most companies typically do. But like, for example, with Altria, I assumed on the best case scenario that they cut it in half, and I assumed on the worst case scenario that they basically just double it. And then for the analysts, I just assume they keep it about the same. And that's probably the most common set of assumptions I use for most companies, is I just run with that. And that usually distributes me an assumption that their debt might go up a little bit, which is what I consider to be a pretty safe assumption for most companies. For RDS.a, we're actually being extra conservative on that front. We're actually assuming on the best case scenario that they only pay down about a third of their debt. And by the way, they actually have a very vocal plan about paying down their debt. That's actually something that when you listen to the earnings calls and you listen to the CEO, whose name I'm not bothering to learn, they actually talk about this a lot. Like, this is something that they're actually actively doing, is paying down their debt. So in a sense, I am punishing them by not assuming otherwise. Although that's not necessarily true. Yeah, okay, it is true. Like I said, because other thing is that sometimes for some companies, more debt is actually better. Depends on the variety of factors for that to happen. But for some companies, that's true, but not for them. But either way, so we're assuming in the best case scenario that they pay down about a third of their debt. And the worst case scenario, we're assuming they triple it instead of doubling it. And that has to do with, like I said, the fact that they would be going at a loss, but that their business would still be super necessary. That's the thing. It's like, even if they were running at a loss and basically going to be going bankrupt in 5 to 10 years, those 5 to 10 years, capital would still be thrown at them like crazy in order to make sure that they operate, because of the interconnectedness that they have with the rest of the economy. So in the worst case scenario, I'm assuming that they would take on a massive amount of debt before going bankrupt, which is likely the case, even more so than most companies. But either way, that's essentially just one other way of being extra conservative. And then on the analysis expectations, we actually assume that it just stays about the same, but slightly upward, which again, compared to their outspoken plans, that's actually being kind of unfair to them. But it also doesn't change the value much, as you can see. It literally only shifted it about 25 cents to maybe be a little bit more generous to them in that front, which I guess I'll leave it that way. But yeah, so that's pretty much all. We will look at the overall summary of it now. Well, actually, let me, I guess, adjust the interest coverage, because I did shift a couple of these things, so I want to make sure it's still 100% accurate on their expected default possibilities. They definitely have a higher percentage of default depending on interest coverage ratios than plenty of other companies. But like I said, they also just kind of have a unique position where, compared to many other companies, financial institutions will likely be willing to throw much larger bones to them. So even under the worst case scenarios, they're likely to get the capital they need, even to go out of business. But regardless of that fact, we still have an expectation for them to possibly be at default risk of about 3% per year for the next 5 years. It's still relatively high. And, in the best case scenarios, it's relatively low, but in those worst case scenarios, it does start to climb pretty precipitously. And the fact that we're evenly distributing those outcomes makes it worse, because a lot of times the worst case scenario is we only distributed about 5%, because we usually use approximately a normal distribution. And so when we have a high number in the worst case scenario, it's usually lowly distributed. So whatever, like I said, it's just sort of more ways in which we're being extra conservative. Oh, and one other thing I didn't talk about, because we did talk about this with the pharmaceutical companies that we covered the other day. I was talking about the development costs and related to patents and how that affects themselves. Well, with commodity companies, that's another example of where we actually deviate from our standard 5-year development cost amortization. Like I said, like with tech companies, I just use a 5-year amortization. It's like we assume R&D is an asset. We don't assume that R&D is an expense, which is what GAAP accounting typically does. We typically add back R&D to the income and consider it to be part of the income, and then instead take that expense and we put it on their balance sheet, and we assume that they paid something. They paid for something. It's not like they didn't buy something, but instead of it just going down the drain, we assume it becomes an asset, because R&D is an asset. The only argument is about how long does the effects of it last. That's really where you can have a debate. It's not a debate that it is a useful asset, because capital assets are things that have benefits over multiple years. And if you're going to try and tell me that R&D doesn't have benefits over multiple years, well, then I would ask, why are we doing R&D? That's I think that's a pretty straightforward, logical thing to come to a conclusion with. But you can make an argument about how long it lasts, and for most companies, I just go with the 5-year number, because I'm using a 5-year forward projection for most things. I just think that 5 years is about the max that an investor can reasonably make assumptions in the future. Technology changes so fast that I think it's kind of ridiculous to try and do 10-year valuations, which is what most people do, is 10-year valuations. Or some people do even longer than that, 15-20-year valuations. Listen to some of the things people talk about with Tesla, and that's exactly what you see. They're like, well, but 10 years from now, this is what they're going to be making. It's like, it doesn't matter what they're doing 10 years from now. You have to be able to earn a return between now and those 10 years. So you're not, they're often not discounting back for risk and opportunities. Anyway, whatever, we're getting distracted again. R&D costs 5 years for most companies is what we typically do. Like I said, with the pharmaceutical companies, we went with 10 years because R&D patents actually last 20 years. And so we're actually being conservative on that front by only using 10 and just assuming that the patent's half gone already for most companies. That the patents are half deteriorating, that they're trying to recreate the patent for their drugs. But with commodity companies, you can actually get a little bit more precise. Funnily enough, there's metrics, there's things you can do to come up with a little bit more of a clear understanding of just how long their R&D is likely to last them. And that has to do with their reserve numbers, which again, we only get in the annual report, so I can't really update that right now. I can't even really show you it, but the point is, you can look in there in your report. It's usually somewhere in the fine print. You can find it somewhere in the 200-page thing, that you'll find what their reserves are, what their untapped reserves are, estimates on probabilities of those numbers being accurate, and then you can also compare that with their trends of just how many barrels that they've been using at what rate. And then you can use some basic algebra to figure out approximately how many years left of reserves they have, which, voila, based off of current usages from, in December was when I calculated this number. But at that time, approximately, they had 7.38 years worth of reserves left, assuming they did no more R&D, which again, this is what we're assuming what their future R&D is going to give us. So that's basically what I use, is 7.38 years to amortize those costs across. So instead of over this 10-year period, they had an average of about $4 billion a year in development and exploration costs. but we're actually saying that in reality only about 2.5 billion of it was a real expense, and the rest of it is more like an asset. So anyway, yeah, just forgot that one little detail kind of need to talk about. So anyway, that's the valuation of Shell. This is what we come up with. 5 years ago they had $268 billion in sales. Last year it was only $182 billion, which means that their sales dropped by 7.5% per year for 5 years. It's sort of an illusion because, like I said, they actually had much higher revenues than 5 years ago, only in 2019. And it's just because of the crisis that their sales were so low last year. And same thing can be said for the sales to capital ratio, although this is actually the 3-year average because what we were using. And same thing for the returns on invested capital. The returns on invested capital were crushed because of the impairment to their asset base and the low returns. And then said they had about 32% debt to equity, default risk of a pretty reasonably meaningful amount, about 2% per year, and then pretty low margins on the overall 3-year average, which includes the negative loss from last year. So that's the thing that has to be kind of taken into account, is that we're talking about 4.26%, a 5.38%, plus a negative 11% because of the crisis here. And I mean, that's sort of it's worth keeping that in mind, because even when oil prices had crashed after 2015, like 2016 or whatever, they didn't have negative margins then. They just had really low margins. So that's my point. Is like last year really was a very especially negative circumstance for them that isn't really likely to occur. But either way, like I said, they had a massive decrease in profit because of the huge losses last year, which is part of the reason that the profit growth is just saying NA, because it's meaningless to refer to a growth rate when you're going from a negative to a positive. It's a meaningless number. But either way, 5 years ago they were selling for $46 per share. Now they're selling for about $40 per share. They have a 2.86% dividend at the current price, discount rate about 8.76%. Like I said, we have a commodity price neutral set of assumptions about the probabilistic nature of the future. We're not trying to make any assumptions about oil prices whatsoever. We're trying to basically say, who knows what could happen with oil prices? It could be anywhere between $27 a barrel and $198 a barrel. But overall, on average, we're actually expecting 5 years hence, we'll have about oil prices of $82 a barrel. That would give us a distributed revenue outcomes of about $383 billion, which incidentally is higher than it was last year. Not majorly so, but it was. Compared to last year, it would be like a 15% sales growth. But again, that's taking into account the massive decrease from last year. It would really only be like a few percentage points of growth per year from 2019. So that's better. That makes much more sense. And then we're assuming their sales to capital will climb back up closer to what the 3-year average was in 2019, which would make sense. In fact, it'll be a little bit lower than that. But we're assuming their returns on invested capital will climb back up to relative to where they were too. It's actually going to climb a little bit, but that's partially because of the really high returns on invested capital that would happen if those better outcomes happen. But we'll see. Like I said, this would be record oil prices, and this would be basically record low oil prices. So the possibilities are all over the place with that. And then debt, we're actually assuming they take on a huge amount of debt. According to their spoken plans, that's not the case. So that's one area in which I really am being extra conservative in punishing them. And that may not be the case. And if that ends up not happening, if they end up paying down their debt much better, then I mean, the outcomes will be better. That's just the truth. But I'm fine with being conservative in that way. And then the default risk, like I said, we're also assuming that there's about a 3% chance of default per year for the next 5 years because of locking up of capital markets or something. So that's also pretty conservative, I'd say. And then we're assuming their profit margins is about 4.75% per year at that point. Again, including a lot of distribution of really good outcomes. And we're looking at higher oil prices than it is now, so it only makes sense that you have a reasonably high margin under those circumstances. But that would either way only give you about a profit about $21.8 billion, $22 billion or so, which compared to for example, that was approximately the profit that they had in 2018. That was approximately, they had less than the profit they had in 2013. See, so I mean, or 2012. See, like back then they had much more profit, and then oil prices came down in 2015. And so they've been kind of lagging through with that. In 2018, they had a big boost in the prices there, but they also had the tax benefits that were going on in that year too. So, point is it's not unreasonable, I don't think, of a profit assumption. And based off of that, with that discount rate, that gives a present value of 51.27, which makes it 29% undervalued from current price, with distributed 5-year forward targets of anywhere between $17 a share if oil prices crash to that level. Although, like I said, under that circumstances, they're basically going to be going bankrupt. And the only reason that you actually get this much value out of it is because you'd be getting dividends through those years, as well as there's probably a liquidation value. Maybe, I think. Is there a liquidation value? Yeah. Okay. Yeah, there is. There's currently about $4 per share of liquidation value, and I use a pretty conservative liquidation method. It's not just book value. So essentially, yeah, under these circumstances, they basically go bankrupt, but you collect about $4 to $6 a share, because it'd probably increase over that time frame in liquidation when the company goes out of business. Not to mention you would have collected dividends along the way. So we would have ended up getting about $17 a share under that circumstance for that time, which is still, you know, like a 50% loss under the worst case scenarios, but it also distributes to the potential upside of maybe $200 a share if oil prices really went through the roof. So there's possible outcomes all over the place, but we distribute about a $78 price, which wouldn't even be record highs. So that's pretty reasonable. And that gives us expected return of about 14.5% per year for the next 5 years, which is a pretty satisfactory amount, in my opinion. That comes to, you know, in the range of 2.5 times of the current market expected return. So it's a pretty good amount. And then the pricing metrics for the regression outputs are pretty positive for Shell as well. And for commodity prices, we had this fourth column that was been empty for pretty much every stock we've done. This column has been just kind of empty because they didn't have drivers, but we do include a fourth regression output for that, which is exactly what we talked about, where you could just ignore the whole revenue regression and just do a price regression. Well, we put that right there. So the regression output for the pricing says that it should be $61 a share, which is 54% outside for that. But then we use, like I said, the price to book, price to sales, price to earnings to growth, and enterprise to capital, which on all bases is cheap. But that's partially because of the way that the market is discounting this entire industry. You know, like all oil stocks look cheap. Oh, Google just cracked out on me. Okay, it worked. There we go. Sorry. Sometimes my spreadsheets start to freak out. But anyway, like I said, they're heavily discounting this whole industry, and so really that just kind of makes it look cheap across the board. It's like if you just look at every stock in the S&P 500, all the oil stocks are going to look cheap. It's basically just a fact. They all look cheap, just like banks all look cheap, and it's because nobody wants to own any of the companies in that industry. But the point is, when people do that, often real values actually show up, because it's not about what the market thinks, it's about what the price you're paying for the return is. So whatever, the pricing out regression suggests a price of like $96 a share, which would be way more upside. Actually, it puts it into some of those better circumstances. But like I've said before, oftentimes the pricing does come up with more into the future than like the present value range, but we make decisions based off of this number primarily. It's just, this is kind of like an extra little piece to think about. But yeah, either way, so that's Royal Dutch Shell, and Altria. We also, we did Altria as well. We can go take a look at where they come out on our little watch list. Like I said, they're kind of over here in the portfolio because they actually are stocks that we do own. But if we go look on our graphs, projected profit margins against the adjusted PE, which Shell's not going to be on this one, right? Because they don't have, they lost money last year, so they're not going to be on here. But you can see MO's on here. They are to the right of the median and the average, so that makes their profit margins better on average than the overall group that we are looking at. But they are pretty much right on the line as far as their cheapness. So Altria is not super cheap, but they are high quality, I guess you could say, because profit margins is generally more of a qualitative factor. But if we shift to the EV to sales with projected excess returns, which will allow us to put Shell into the mix, because it doesn't matter if they have a loss or not. You can see that they are really low on the EV to sales. They're extremely cheap. They're really close to the bottom line here. There's only a few stocks that are as cheap or cheaper, but they also have a very, very tiny amount of projected excess returns. And that's partially because of well, frankly, how rough it's been for the last several years for them. And so frankly, they would, even under the relatively positive expectations that we have for them for the next 5 years, they would basically just be climbing out of a hole. That's sort of the nature of it. So not super great on that front, but they are extremely cheap. And so it really just comes a question of whether or not that cheapness is cheap. It's like, is it cheap for cheap's sake, or is it cheap for good sake? It's like there's a positive correlation, there's a positive connotation of cheap, and there's also a negative connotation of cheap. And that's sort of the argument with Royal Dutch Shell. It's like, is it good cheap or is it bad cheap? I think it's good cheap. We'll find out. And then the third graph with the expected COGR, which is more of our actual decision-making tool, along with the excess returns. Well, under that circumstance, Royal Dutch Shell has pretty high expected COGR, much higher than the average and the median. Their excess returns, though, are, as we just said, pretty abysmal. And this is their current excess returns, not the projected excess returns. They currently have negative excess returns because, like I said, the last several years with the chaos of the oil market since 2014, 2015, really, it's actually in negative territory. But that's why on this one we have the projected excess returns, because frankly, it's more about thinking about what are the excess returns going to be in the future, not so much about what they are now. That's more of like thinking about them in terms of return. And when you're using the current excess return, it's more of a qualitative thing rather than a forward return figure. So in this case, it's much more of a qualitative versus quantitative. And on the qualitative, it's kind of low quality, but high return potential. And then, well, MO is up here, which is a little bit better. They're just barely to the right of the average, and they're actually kind of like behind the median as far as the expected COGR. So Altria's return expectations are not super high, but they do have a stronger qualitative, probably partially because of their branding and pricing power. So yeah, those are the two companies we're doing today. This has been Live Valuation. We'll be back on Friday. We stream Mondays, Wednesdays, and Fridays on YouTube, Twitch, DLive, and Facebook. Please subscribe to the channel, like, share around, comment below, all of the video things. I'm not sure what we're going to be doing on Friday, but maybe not two companies at once. It's like I said, I've been doing two companies at once for the last couple streams, partially because they were companies that I already own, so I was able to don't have to work as much on it. I can kind of just talk about it and cover these things, and trying to cover those positions. And I also want to get through them faster because I want to get back to valuing companies that we don't own, so that we can keep looking for opportunities. But at the same time, I sort of have to eventually reveal the portfolio, right? I mean, it's kind of part of the fun of this. So either way, catch you all next time.